Two superpowers, one resource, a battle for wealth that shapes the global economy. On one side, Saudi Arabia, with its massive low-cost oil reserves and centralized control that can sway global markets. On the other, the United States, a technological powerhouse extracting oil through innovation, efficiency, and sheer production volume. Who makes more money per barrel? Who truly wins the financial race of oil? Today, we're diving deep into the numbers, strategies, and secrets behind the oil empires of the US and Saudi Arabia, and uncovering which nation gets the highest return on its most valuable resource. In the world of global energy, two nations stand at the center of oil dominance, shaping markets, influencing geopolitics, and generating immense financial returns. The United States and Saudi Arabia are not just oil producers. They represent two entirely different economic philosophies built around the same resource. One is a capitalist superpower driven by private enterprise and technological innovation. The other is a state-controlled powerhouse whose wealth is deeply rooted in vast, easily accessible reserves. The question is not simply who produces more oil, but who extracts the greatest financial return from every barrel pumped out of the ground. To understand this rivalry, you need to look beyond production numbers and focus on efficiency, cost structures, pricing power, and long-term sustainability. Oil is not just about volume. It is about how cheaply it can be extracted, how effectively it can be sold, and how much profit remains after all expenses are accounted for. This is where the contrast becomes fascinating. Saudi Arabia possesses some of the largest and most accessible oil reserves in the world. Its oil fields are massive, concentrated, and relatively easy to exploit. This gives the country a natural advantage in production costs, allowing it to produce oil at some of the lowest prices globally. In contrast, the United States operates a far more complex and expensive system, relying heavily on shale oil extraction, which requires advanced technology, constant drilling, and higher operational costs. However, the American system brings something Saudi Arabia historically lacked: flexibility and innovation. U.S. companies can rapidly scale production up or down depending on market conditions, adapting quickly to price changes. This dynamic nature allows the United States to respond to global demand shifts faster than traditional oil producers. Another key difference lies in ownership structures. In Saudi Arabia, oil production is largely controlled by the state, meaning profits flow directly into government revenues. In the United States, production is handled by private companies, meaning profits are distributed across corporations, shareholders, and the broader economy. This creates two entirely different definitions of financial return. Is it better to have lower costs and centralized profit, or higher costs with distributed economic benefits and technological advancement? That question sits at the heart of this comparison. As global energy demand evolves and the world slowly shifts toward renewables, the efficiency of oil production becomes even more critical. So, when we ask which country has the higher financial return on oil, we are really asking a deeper question about economic strategy, resource management, and future resilience. The answer is not as obvious as it seems, and the numbers alone do not tell the full story. When it comes to determining financial return on oil, nothing is more critical than the cost of production. Revenue might grab headlines, but profit is what ultimately defines success. And profit begins with how much it costs to bring a single barrel of oil to the surface. This is where the gap between the United States and Saudi Arabia becomes dramatically clear. Saudi Arabia enjoys one of the lowest production costs in the world. Estimates often place its cost of extracting a barrel of oil between $3 and $10. This is due to its unique geological advantage. The country's oil reserves are located in large, pressurized reservoirs that require minimal effort to extract. In simple terms, Saudi Arabia spends very little to get oil out of the ground, which means even when global oil prices fall, it can still remain highly profitable. The United States, on the other hand, operates in a completely different environment. Much of its recent oil boom has been driven by shale extraction, particularly through hydraulic fracturing, also known as fracking. This process is technologically advanced, but significantly more expensive. Production costs in the U.S. can range from $40 to $70 per barrel, depending on the region and efficiency of operations. That means American producers require higher oil prices just to break even. This difference creates a major financial contrast. When oil prices are high, both countries profit, but U.S. companies often see their margins squeezed by higher operating expenses. When prices drop, the pressure intensifies. Many American producers are forced to reduce output or even shut down operations, while Saudi Arabia can continue producing profitably due to its low-cost advantage. However, cost is not the only variable that determines return. Efficiency and scalability also play a role. U.S. companies have developed technologies that improve extraction rates and reduce waste over time. While their base costs remain higher, continuous innovation has steadily pushed those costs downward. This means that although the United States starts at a disadvantage, it is constantly working to close the gap. Saudi Arabia, meanwhile, relies on its natural advantage rather than technological breakthroughs. Its focus has historically been on maintaining production capacity and controlling supply to influence global prices. This strategy works well when combined with low costs, allowing the country to dominate during both high and low price cycles. Ultimately, when purely analyzing cost versus output, Saudi Arabia clearly leads in financial efficiency per barrel. Its ability to produce oil cheaply gives it a structural advantage that is difficult to replicate. But the story does not end here, because financial return is also shaped by pricing power, market control, and global influence, which introduces a new layer of competition between these two oil giants. Beyond the cost of production, financial return on oil is heavily influenced by a country's ability to control prices and sway global markets. In this arena, Saudi Arabia and the United States adopt vastly different strategies, reflecting their distinct economic models and geopolitical positions. Saudi Arabia, as the largest producer in the Organization of the Petroleum Exporting Countries, OPEC, wields considerable pricing power. By coordinating production levels with other OPEC members, Saudi Arabia can influence global oil prices to its advantage. For example, during periods of oversupply, the kingdom has strategically cut production to stabilize prices, ensuring higher revenue per barrel. Conversely, in times of high demand, it can maintain or increase output to capture maximum profit. This centralized control allows Saudi Arabia to generate consistent financial returns, even amidst volatile markets. The United States, in contrast, operates in a highly competitive and decentralized market. American oil production is dominated by private companies rather than the government, which means pricing decisions are largely market-driven. U.S. producers respond to international oil prices, but they have limited ability to manipulate the market on a global scale. Their financial returns depend more on market timing, efficiency, and innovation than on strategic production cuts. However, U.S. producers have developed a form of pricing resilience through diversification and technological innovation. By producing oil from multiple sources, including shale, deep-water offshore fields, and conventional onshore fields, U.S. companies reduce dependency on any single market or price fluctuation. Moreover, advancements in fracking, horizontal drilling, and automation have lowered operational costs and increased output flexibility. This allows the U.S. to react rapidly to price spikes or drops, providing a different type of financial advantage. Another key factor in pricing power is market access. The United States enjoys a vast domestic market and the ability to export crude and refined products to a global audience. Saudi Arabia, while heavily export-oriented, relies almost entirely on foreign demand, particularly from Asia and Europe. This dependency can make its financial returns more sensitive to global economic slowdowns or geopolitical tensions affecting demand. In addition, strategic reserves and inventory management play a role. The U.S. maintains significant strategic petroleum reserves that can be leveraged in times of crisis to stabilize prices or meet domestic demand. Saudi Arabia, with its centralized state oil company, Aramco, can control production schedules with precision, but it lacks the diversified domestic buffer that the U.S. enjoys. These differences illustrate that financial return is not solely about low production costs, but also about the ability to influence the price at which oil is sold. Ultimately, Saudi Arabia's market control allows it to achieve high returns per barrel during most global conditions. The U.S., while lacking centralized influence, compensates through technological efficiency, flexibility, and market diversification. Each model offers distinct advantages, and comparing them requires examining both immediate profits and long-term financial sustainability. The interplay of cost, technology, and market power sets the stage for understanding which economy truly extracts the highest return from its oil resources. When comparing financial returns from oil between the United States and Saudi Arabia, technology and operational efficiency emerge as crucial factors. While Saudi Arabia benefits from some of the lowest extraction costs in the world, the United States leverages technological innovation to enhance profitability, creating a different pathway to financial return. In the U.S., shale oil extraction has revolutionized the energy sector. Techniques like hydraulic fracturing and horizontal drilling allow producers to tap into previously inaccessible reserves. Although these methods are capital-intensive, they provide the flexibility to scale production quickly in response to market prices. This agility allows U.S. producers to maximize revenue during periods of high oil prices while minimizing losses when prices fall. Over the past decade, innovations have steadily reduced cost per barrel, narrowing the gap with low-cost producers like Saudi Arabia. Additionally, automation and data analytics have transformed operations. Advanced monitoring systems optimize drilling schedules, predict equipment maintenance needs, and improve extraction efficiency. These technologies reduce wasted energy, minimize operational risks, and ultimately enhance profit margins. By contrast, Saudi Arabia relies largely on conventional oil extraction methods, where natural geological advantages reduce the need for costly technological intervention. While this keeps operational costs extremely low, it also limits opportunities to innovate or significantly increase extraction efficiency beyond established capacities. Energy diversification strategies further influence financial returns. U.S. producers often invest in both crude oil and refined products, including gasoline, diesel, and petrochemicals, allowing them to capture value at multiple points in the supply chain. This vertical integration ensures that financial gains are not solely dependent on crude oil prices. Saudi Arabia, while investing in refining and petrochemicals through Aramco, primarily earns revenue from crude exports, leaving it more exposed to global market fluctuations. Environmental regulations and sustainability initiatives also impact efficiency and costs. U.S. producers face stringent environmental standards, which initially increase costs, but ultimately incentivize cleaner, more efficient production methods. Investments in carbon capture, emissions reduction, and renewable integration improve long-term financial stability by reducing the risk of regulatory penalties and aligning operations with global energy transitions. Saudi Arabia, although increasingly investing in sustainability projects, historically has had less regulatory pressure to optimize environmental efficiency, focusing instead on maximizing output from its abundant reserves. Moreover, research and development in the U.S. energy sector contributes to long-term financial returns by continuously improving recovery rates and lowering operational expenses. Each technological breakthrough, whether in fracking fluid chemistry, drilling accuracy, or predictive analytics, directly translates to more oil extracted per dollar spent. While Saudi Arabia maintains some R&D programs, its financial returns historically rely on the sheer size and accessibility of reserves, rather than efficiency gains from innovation. In conclusion, technological innovation and operational efficiency create a competitive advantage for the U.S. oil industry, offsetting its higher baseline production costs. While Saudi Arabia's natural reserves provide immediate financial strength, the United States demonstrates that strategic investment in technology can substantially improve returns over time, highlighting the contrasting pathways through which both nations extract value from oil. To truly compare financial returns on oil between the United States and Saudi Arabia, we must move beyond production costs and technology and examine revenue, profit margins, and the broader economic impact of oil on each nation. These factors determine not only how much money is made per barrel, but also how it contributes to national wealth and long-term financial stability. Saudi Arabia, with its state-owned Saudi Aramco, converts its oil production into massive government revenue. Aramco is not only one of the most profitable companies in the world, but also a primary source of funding for Saudi Arabia's national budget. During periods of high oil prices, the kingdom can earn tens of billions of dollars monthly from crude exports alone. The low extraction costs amplify these profits, allowing the government to generate high margins on every barrel sold. This centralized revenue model ensures that profits are directly reinvested into public infrastructure, social programs, and strategic projects, giving Saudi Arabia a high immediate return on oil. The United States, conversely, benefits from a more distributed economic model. Oil revenues flow through private companies, shareholders, and local economies, creating a ripple effect across multiple sectors. While production costs are higher, the U.S. can achieve significant aggregate revenue because of share production volume and diversified output, including refined products and petrochemicals. Profit margins per barrel may be lower compared to Saudi Arabia's minimal cost model, but the overall contribution to the economy is substantial. Taxes, royalties, and corporate investment further multiply financial returns beyond the oil sector itself. Economic resilience also plays a role in assessing returns. Saudi Arabia's heavy reliance on oil revenue makes it vulnerable to price swings and global demand shifts. To mitigate this, the kingdom has launched Vision 2030, a diversification plan aimed at reducing dependence on oil by developing tourism, technology, and renewable energy sectors. While ambitious, these initiatives are still in progress, meaning that short-term financial returns remain heavily tied to oil prices. The United States, in contrast, benefits from a more balanced economy. Oil is a critical component, but not the sole driver of national wealth. The combination of technological innovation, domestic consumption, and export capacity allows U.S. producers to weather price volatility more effectively. Even when oil prices dip, the integrated supply chain and diverse energy portfolio help maintain overall financial stability. This broad economic impact increases the effective return on oil by ensuring that profits circulate through various industries rather than being concentrated in state revenue alone. Another dimension is global market influence. Saudi Arabia's ability to control production within OPEC allows it to influence global prices and maximize per-barrel returns strategically. The U.S. may lack centralized control, but uses its production flexibility and technological edge to respond to price fluctuations efficiently, capturing revenue opportunities as they arise. In essence, Saudi Arabia excels in high-margin, centralized financial gain, while the United States achieves broad, resilient economic returns with distributed benefits. In conclusion, evaluating revenue, profit margins, and economic impact highlights two contrasting approaches. Saudi Arabia achieves high immediate returns per barrel through low costs and centralized control, while the United States leverages volume, innovation, and economic diversification to generate substantial long-term financial benefits. Understanding these differences is critical to assessing which nation truly benefits most from oil production in terms of financial return. As we reach the final analysis, the question of which nation,
United States or Saudi Arabia achieves higher financial returns from oil requires a synthesis of all the factors we've explored: production costs, technological efficiency, pricing power, revenue, profit margins, and economic impact. Both countries approach oil wealth from fundamentally different economic and strategic perspectives, each producing distinct advantages and limitations. Saudi Arabia's financial return is anchored in its natural advantages. Low production costs, combined with vast, easily accessible reserves, create a structural edge in profit per barrel. Centralized control through Saudi Aramco amplifies this advantage, allowing the kingdom to translate oil extraction directly into national revenue. Pricing power within OPEC further enhances returns, enabling the country to influence global oil prices strategically. When oil prices are high, Saudi Arabia maximizes profits with minimal operational expenditure. Even in periods of price volatility, the kingdom can leverage low costs and production control to maintain financial stability.
The United States, while facing higher production costs due to shale extraction and complex operational requirements, generates financial return through adaptability, technological innovation, and market diversification. Advances in fracking, horizontal drilling, automation, and data analytics have steadily reduced costs and improved efficiency, allowing U.S. producers to capture substantial profits despite higher baseline expenditures. Additionally, the distributed economic model, where revenue flows through private corporations, shareholders, and local economies, ensures that oil wealth contributes broadly to economic growth and stability, even if per-barrel margins are lower than Saudi Arabia's. Comparing the two models reveals a nuanced picture. Saudi Arabia achieves high immediate financial return per barrel and centralized profit generation, making oil the backbone of its economy. The United States, however, trades per-barrel margin for flexibility, innovation, and resilience, capturing financial return across multiple layers of the economy. Each approach has implications for long-term sustainability. Saudi Arabia's dependence on oil makes it more exposed to market fluctuations, geopolitical tensions, and the global energy transition. Its Vision 2030 initiative aims to reduce this vulnerability by diversifying economic activity, but oil remains central to current financial success. The U.S. model, with its diversified and technologically advanced infrastructure, is better positioned to adapt to changing energy demands while continuing to profit from oil production. Looking ahead, both nations face challenges that will shape financial returns. Global shifts toward renewable energy, electric vehicles, and carbon-neutral policies could reduce demand for fossil fuels, affecting both production and pricing strategies. Saudi Arabia will need to balance maintaining high-margin oil revenues with investments in alternative sectors to secure long-term financial stability. The United States will need to continue leveraging technology, efficiency, and market flexibility to sustain profits as global oil demand evolves. In conclusion, determining which country achieves higher financial return on oil depends on the perspective. Saudi Arabia excels in per-barrel profitability and centralized revenue generation, while the United States maximizes broad economic impact, adaptability, and innovation-driven returns. Both strategies offer unique advantages, and each country remains a dominant force in global energy markets. Ultimately, the rivalry between the U.S. and Saudi Arabia demonstrates that financial return on oil is not a simple measure of price or production volume, but a complex interplay of cost, efficiency, market influence, and strategic economic management. The battle of oil financial returns is far from simple. Saudi Arabia dominates in low-cost, high-margin profits, while the United States leverages innovation, efficiency, and a diversified economy to maximize its gains. Both nations have unique strategies, each with its own advantages and risks. As the world moves towards renewable energy and fluctuating oil markets, the question remains: who will adapt faster, and who will continue to profit the most? One thing is certain: oil isn't just a commodity, it's power, wealth, and the engine driving global influence. The race isn't over, and every barrel counts.